Welcome back to the deep dive. This week was a massive week of policy shifts and market surprises, and we're going straight to the source material you shared.
It really was.
Our mission here is to translate this incredible confluence of global macro signals, India's domestic reforms, and some very specific stock movements from, what was it, December 15th through the 20th,
That's the window.
and turn all of that into actionable intelligence for you.
It was an inflection point week, no doubt, both globally and at home. You had the U.S. delivering a shock on inflation, the RBI injecting serious liquidity, and SEBI just fundamentally redrawing the structure of trading costs.
A lot to unpack.
So we're connecting those powerful top-down levers directly to the price action in your portfolio.
Okay, let's start with the U.S. then, because
Yeah.
the market reaction to that surprise CPI print, it dropped on December 18th, and the reaction was just instantaneous and global.
It was.
The key numbers were headline CPI at 2.7%, core at 2.6%, and critically, both were way cooler than projections, which were sitting around 3.1% and 3.0%.
Yeah, that is what you call a clean miss, but in the right direction. And a 2.6% core inflation rate, that's the slowest pace we've seen in nearly 6 years.
So why is that such a big deal?
Well, it just fuels the risk-on sentiment everywhere. It restores real hope for that year-end Santa Claus rally.
Right.
And more tangibly, it really increases the probability of the U.S. Fed delivering another rate cut, maybe as early as Q1 2026.
So cooler inflation in the U.S. gives the Fed breathing room, maneuvering room. But does it give them a license to just ignore all the geopolitical volatility? Is 2.6% still a bit too hot for them?
That is the right question to ask. I mean, 2.6% is manageable, but they won't declare victory until they're closer to that 2% long-term target.
Of course.
But what's fascinating here is the global narrative. It's clearly dominant. We're already seeing the Bank of England cut by 25 basis points. The ECB paused. BOJ is expected to hike. But the overall trend, it's a green light for FII flows to emerging markets like India.
And speaking of rate cuts, the RBI certainly didn't wait for any global signals. They've laid out a very, very confident domestic strategy.
They really have.
The Monetary Policy Committee, they unanimously cut the repo rate by 25 basis points to 5.25%. That was on December 5th.
That was a move of pure conviction. Look at the guidance that came with it. The RBI dramatically upgraded its FY26 GDP growth projection from 6.8% all the way up to an ambitious 7.3%.
Which is a huge jump.
A huge jump. And they paired that with revising CPI inflation lower down to a benign 2.0%. This belief in accelerating growth with contained inflation. That's exactly what Governor Malhotra meant by a rare Goldilocks period.
Okay, this all sounds very positive, but the liquidity measures announced were, well, they were highly technical. I want to spend a minute here. The RBI announced 1 lakh crore in FOMO purchases and a massive $5 billion rupee swap.
Right.
Why use a swap? Why not just direct intervention?
That is an excellent point for our listeners. The OMOs are straightforward, right? They inject cash. But the swap is the genius move.
Yeah.
The RBI uses a dollar-rupee swap to manage short-term liquidity without signaling a long-term stance on the rupee level.
How? Okay.
They're essentially saying, we need short-term rupee cash in the system, but we don't want the market to think we're defending this specific rupee level. It's a tool for nuance.
And the market definitely took note. On December 19th, we saw that dual institutional support. DIIs poured in over 5,700 crore. FIIs added another 1,800 crore.
Absolutely. That dual buying signals real conviction in the RBI's guidance.
Wait a minute, though. Let's play devil's advocate here. All this domestic easing and liquidity injection, it's happening while the rupee just plunged to a record low. It's down over 5% this year.
A huge headwind.
Driven by U.S. tariffs, geopolitical uncertainty. How do we reconcile that internal confidence with the external currency risk?
That is the critical balancing act. We can't ignore it. A softer monetary stance, you couple that with trade friction, and you have a major currency headwind.
Right.
And while the governor might say a 5% depreciation boosts GDP by about 25 basis points through exports, that same 5% depreciation can lead to 35 basis points of inflation.
But it's a trade-off.
It's a huge trade-off. So for you, the trader, the question is, can the RBI's liquidity support fully counter that currency pressure? The battle is being fought right now in the Forex markets.
Okay, let's switch focus to the rulebook. SEBI.
Yeah.
A major board meeting on December 17th that changes how you trade and invest. The focus was cost and transparency.
This is a major overhaul. It was all designed to streamline the markets and, lower costs for the retail investor. They simplified IPO norms, reorganized stockbroker regulations.
Let's focus on the cost reductions. Because this directly impacts profitability, especially for high-frequency strategies. How exactly does the drop in the derivative brokerage caps change the game?
Oh, this is huge. The cash segment cap fell from 8.59 basis points to 6, but the derivatives cap was nearly halved,
Have.
from 3.89 basis points down to just 2 basis points. When you operate on high volume and thin margins, cutting your brokerage cost by almost 50%, it's a game changer. It makes high-frequency strategies and retail options selling significantly more profitable.
And what about for the long-term mutual fund investor? They replaced the old expense ratio framework with this base expense ratio, or BER.
Correct. The BER just aims to make expenses more transparent by excluding things like GST and STT from the base calculation, so you know exactly what you're paying for fund management. And that, combined with things like tighter 6-month lock-in rules for non-promoters, it's all designed to enhance the quality of the market.
With those macro and policy pillars laid out, let's see where the money is flowing. We'll start with the headwinds, and that brings us straight to the pharma sector. It's been pretty volatile lately.
It has. Volatility has been driven by persistent U.S. FDA scrutiny and, more fundamentally, margin compression. I mean, look at Ekim's Drugs, India's largest contract manufacturer.
Right.
Their stock is down 38% from its 52-week high.
So what's driving the pain at Akim's and others like Natco Pharma, which is also down over 38%?
Well, the financials point to one massive pressure point: the continuing downward spiral of active pharmaceutical ingredient API prices across all categories.
And the core issue there isn't domestic, is it?
No, it's not domestic production. It's the massive inventory unwinding in China after their reopening. That sudden flood of cheap supply is just collapsing prices globally, and it's crushing the margins for Indian companies who bought raw materials at higher prices.
So if the sector's facing that kind of margin compression, is the old narrative of pharma's defensive appeal actually dead for now?
Not dead, but it's certainly challenged. The defensive appeal comes from two things that are still intact: steady domestic healthcare consumption and, crucially, continued export growth to the massive U.S. market.
So the foundation is still there.
The foundation is there. Short-term earnings are cloudy, but the underlying necessity and the export runway still provide a resilient floor for the top players.
Okay, so if pharma's playing defense, who's playing offense? And that leads us directly to consumer momentum, specifically the FMCG space and the action in Tata Consumer Products.
Yes. Tata Consumer is showing textbook bullish behavior. And what's fascinating is the derivative market action. We saw a 21.87% surge in open interest.
Which suggests new money coming in.
Exactly. This isn't just traders rolling positions. This suggests fresh, directional bullish bets are being established, and the technicals back it up. The stock is above all its key moving averages, sitting just 1.55% away from its 52-week high.
And this consumer confidence seems to mirror a broader resilience in India's trade picture, despite the tariff wars.
That adaptability is the main takeaway. India's trade deficit narrowed to a 5-month low of $24.53 billion in November, and economists credit this to resilient overseas demand, especially in sectors like engineering goods. They managed to perform well despite facing those crippling 50% U.S. tariffs.
Okay, let's get into the specific triggers, individual names. First up, Axis Bank. This stock took a 4% hit on December 16th. Why the sudden, sharp dip?
The why was a shock to profitability expectations. Management indicated that net interest margin NIM recovery would be delayed
How long?
by 2 full quarters, pushing stabilization out to Q4 FY26 or even Q1 FY27. For a bank, NI is the absolute heartbeat of profitability. This just totally reset near-term expectations and led to immediate selling.
Next up, the quick commerce space. Eternal, the parent company of Zomato. They saw a steep intraday drop of over 5% on December 16th.
Eternal is navigating twin headwinds that caused that heavy selling. First, there was sustained pressure since their Q2 results, and second, the regulatory concerns over the new Social Security Code.
Right, which requires aggregators to contribute 1–2% of turnover to gig worker benefits. That sounds like a fundamental cost increase.
It does, but brokerages seem to have shrugged it off in their long-term models.
Why the optimism?
The key here is pricing power. The cost increase is estimated at only about 2 to 3 rupees per order, and brokerages are optimistic because Eternal has repeatedly shown superior pricing power. They've successfully levied platform fees, other charges.
So they believe they can just pass the cost on.
They can just pass it on to the customer. We also saw that huge block deal, a 0.5% stake for 1,500 crore, which added to the volatility.
Let's discuss the operational chaos at IndiGo. The stock was under intense scrutiny. We're talking about 4,500 flights canceled in early December.
A huge number.
all due to pilot rostering issues. That level of failure must have caused a significant crisis of confidence.
Is the airline equivalent of a system failure, especially when you combine it with the CCI launching an antitrust probe into high-ticket prices,
And with their market share.
over 60%. So any slip-up gets magnified. However, the market, as always, focused on the recovery. The shares rallied 2.90% on December 18th, right after the CEO confirmed that operations had stabilized and the worst was over.
So operational clarity trumped the regulatory threat.
In the near term, absolutely.
Finally, commodities and energy. JSW Steel and ONGC. JSW slipped 5% after announcing that big joint venture with JFE Steel of Japan.
Yeah, that JV involves a massive slump sale, over 24,000 crore. And the decline suggests some investor anxiety around the funding or the structure of that deal, even though the long-term goal is expansion and tech transfer.
And ONGC.
ONGC has been quietly drifting down, lost 5% over the last month. And the simple reason is the commodity cycle.
Yeah.
Brent crude is down 17% over the past year, and that directly pressures their revenues.
So what are the future catalysts for them? They can't control the price of Brent.
No, so they're focusing on volume. They've made promising new discoveries in Mumbai offshore, partnered with BP for new tech, and they have these ambitious plans to nearly double natural gas production by 2030. They're also aligning with India's energy transition goals.
So the stock is basically waiting for new volumes to kick in or for crude to rebound.
That's the story.
Okay, let's translate all this into the technical landscape for next week. With all this volatility, where are the critical support and resistance lines?
Let's use Eternal as the prime example of a confusing technical picture. The stock is consolidating right now near a critical support zone, around 295 to 300 rupees.
What are the mixed signals?
Well, it's trading below all its short-term moving averages, the 5, 10, 20, all the way to the 100 DMA.
Which suggests retail panic.
Exactly. But crucially, it remains anchored above the 200 DMA, which is the long-term institutional anchor. This setup is a classic signal for high-risk traders looking for a dip buying opportunity.
So if it holds that 295 to 300 level,
The target is the short-term resistance around 330. But if that long-term anchor breaks, the whole narrative could change. You could see a much deeper correction.
and we see that same kind of technical tension in JSW Steel, right?
Yeah.
After its M&A news, it's below the short-term averages.
Right, the 520 and 50-day,
Yeah.
clearly signaling a pullback. But it's still trading comfortably above its 100-day and 200-day averages. This suggests the institutional confidence in the long-term story in that Japanese partnership is overriding the short-term anxiety. Long-term bulls are just holding on, seeing this as temporary noise.
Okay, to summarize this incredibly high-impact week, it was defined by decisive domestic policy, an RBI rate cut signaling conviction in 7.3% growth, and SEBI reforms lowering trading costs.
And beneath that macro stability, we saw that classic stock-specific volatility. Nies and delays at Axis, margin hits in pharma.
And the operational recovery stabilizing IndiGo?
The overriding theme, really, is the government's urgent push to create these structural shields against the U.S. tariffs. Fast-tracking reforms in nuclear energy, insurance. It's a battle of internal strength versus external pressure.
So what's the final thought you want to leave us with?
Here's the provocative question. Given the rupee's continuing slump and all this trade uncertainty, will these domestic structural reforms prove fast enough and effective enough to truly overcome the geopolitical headwinds and unlock that ambitious 7.3% GDP growth?
A huge question.
That fundamental tension between policy confidence and global reality is the battle to watch in the coming months.
A fascinating and high-stakes question to close on. We'll be tracking those tensions right here on The Deep Dive. Thank you for joining us.